Welcome to another episode of Stars and Startups. We've had three of this investor's portfolio companies on the show prior to this. This is an investor based out of Mumbai, Vikram Chachra. You've already heard from a few of the founders who are part of his portfolio: Madhu of YAP, Ankit of Signzy, and Rajan of Slice. Oh wait, actually, there's one more. It's also BlueTokai. Matt of BlueTokai has been on the show. Not by design. I've known a few of those founders outside of me interacting with Vikram, and though he's a good investor, which we'll find out, more about him and what he's been up to. So let's welcome Vikram of HCG Capital on the program. Hi, Vikram. Welcome to the show.
Thanks, Varun. Good to catch up here again.
You're an investor and you've also founded a company. So I thought you'd give a great perspective as well of what's happening in the Indian scene. But before we get into some of those things, why don't you tell a little bit about yourself? For audience.
So sometimes I feel like an internet historian, to be honest. I've been building mobile internet companies and more lately financing them since '99. Pretty much from the birth of the mobile internet. That time I was in New York. And the first company actually I created for a mobile environment was, the inspiration was, how do you bring one-click shopping to a mobile device? Because Amazon had just done it, removed this friction point, started to do really well. And so it was natural it would come to the mobile phone. So we set out to do that in '99, raised a bunch of money and did quite well for a while. And then we got dot bombed. We didn't get the timing right, didn't sell the company. And so sold off to Motorola, moved to Silicon Valley. There again created the mobile environment for a leading consumer internet company called Snapfish, which is an online photo services company. So keep in mind, all of this was happening pre-iOS, pre-Android era.
I was just going to say, like, you're talking about one-click shopping on mobile, and you're talking about Snapfish, which I think, pre-Instagram and a lot of these other innovations, Snapfish was the original photo sharing and saving option. Didn't HP acquire it later on? That's what
they bought it for 300 million in cash in '05, which was a big deal that time. So the big exit. Yeah.
That's insane. Did you make some money from that deal?
Very little. I mean, honestly, what I got out of that was, when you do a venture first time around, you make a lot of mistakes. And I did the same thing. And it was very interesting to go build a new business in a company which was doing its 2.0 version. So Snapfish, like many startups, also made mistakes the first time around. They got a second lease of life. Somebody bought the company and they built a new team around that. And I was part of that new team. But second time around, they got everything right. I actually got to witness what is product market fit in a social network. It's just the amazing experience to see that. It's pretty amazing. Great learning experience, honestly.
But Flickr was competition at that point. Snapfish and I think,
Flickr came later. Flickr came a little bit later. We'd already been acquired. This is during the era of Photo, which is acquired by Kodak by that time. Kodak is, notorious for different reasons today with the Robinhood crowd. But actually, there were 36 consumer internet companies just focused on photo services. Only 3 survived. Wow. Very interesting. And I think out of that lot, maybe 2, and then of course everything migrated to Instagram and Facebook. So that bit of history is gone.
I was just thinking to myself, like, even digital cameras were still like sub 8 pixels or anything, right? There wasn't that much happening, and not a lot of people had a digital camera. People were still going for film, and I think even India hadn't seen a lot of digital cameras until late 2000s. Early 2000s, right? So, who are these guys catering to? Like, and what kind of a user base was it like, and what kind of growth did you see?
So Snapfish actually was targeting women, young mothers who wanted to share photos of the kids with the family. And we used to call them back then camera phones. They're very new. The photos were very grainy. The phone was emerging as something like a Swiss knife of sorts, where you can start embedding new things into it, right? Before phones came along, we used to have these GPS devices you'd buy or rent for a car, when you to go wherever you want, the navigator thing curates on your phone. The camera was somewhere else. So many things started getting added. That's why the phone is the center of everything today. So the bet really was that those grainy photos would become high quality photos, and the idea was you take a photo, it automatically uploads to the Snapfish site, so you get one place to sort of aggregate all the photos.
You went to New York to build your company, and then you moved to the Bay Area, right? But you're actually you went to SRCC for undergrad, and then you were in Jamshedpur at XLRI. How did you kind of leap into another continent and build all these businesses?
So I went to NYU to do my business school, and my heart was set in Wall Street. I got a great job. I used to trade bonds in London, actually. So I had the life. Everything's great. Till I buy this damn phone. And it was this Motorola StarTAC phone, which looked like the Starship Enterprise. And I discovered.
Oh, that was a gorgeous phone.
Yeah, it was a gorgeous phone. It had a browser. And I got hooked onto the browser, even though the speed was terrible. And I don't know, I had this very clear moment in front of me that everything is going to start moving from the phone. It made no sense to be tethered to a place to access something as useful as the internet, right? You have to take it along with you. So that was the insight which, if you lose sleep many days on an idea, you might as well go do it.
Right? I also read that you were building mobile payments also very early, and that was pre-Snapfish. Was that where you built a lot of entrepreneurial abilities?
So we had to bundle in this one-click shopping. Obviously, was about payments. How do you streamline payments in the end? So those days, actually, we were thinking of billing to mobile phones, to the mobile phone bill, actually, which was really interesting. So imagine your postpaid bill also has some e-commerce items on it, right? That's how we were thinking. But there were a lot of issues. The carriers wanted to take a lot of money, 65% market share. It's very interesting. I know I'm taking a bit of a segue here. When Steve Jobs wanted to launch a mobile phone, he figured out two things. He said, as long as the mobile internet was left to the hand of the carriers, it wasn't working out because they wanted 65, 75% of the revenues, right? So Japan was 30%, so the developer community was thriving there because there was enough money for them. So the first thing Steve Jobs did is he saw what happened in Japan and made sure that the iPhone would have a similar model, 30%. And today you're seeing a battle play out between Epic, right, who doesn't want to pay this 30% tax, right, and wants to go around, and Apple is punishing them. I think Steve Jobs would not be very happy with the way Apple is going about doing what they're doing right now. But it's interesting that 30 looked good in front of 65, and now 30 looks bad in front of whatever you paid to your card company. Right? That's the question.
But it's an interesting point, right? Because if you look at there is this effort that a company like an Apple, or a carrier gives to creating a payment service, right? And they say, I want a lion's share of this pie, and which is what the battle is between Epic and Apple is. But unfortunately, digital goods don't get the same respect, say, a physical good is, because the assumption is that a digital good has a lot more margin and it will not pinch as much, and you can always change up pricing. Whereas Epic's argument obviously is that if we're able to reduce the price or not give away so much, we can actually engage with the players a lot more, and they can do a lot more.
The OS wars, mobile OS wars were over. People forget there was Symbian and there was some other Palm OS. All of those companies disappeared. So we are living in a predominantly Android and Apple world. So as long as they have a lock on the OS, they have a lot of power. I think what's going to happen is the way these modern monopolies are operating. They are entering into every space. As they say, software is eating the world. So there is going to be antitrust activity. And I think what Apple is doing is going to invite scrutiny with this kind of behavior. But they are desperate too. They want to protect the services revenue, which is very key for them.
After Snapfish, how do you transition to investing? Was there something that started happening because you had a little bit of cash and you started investing? Because I know you have like an early check in PayTM, and you probably wet your beak in that pond.
So actually, it's so early stage building early stage companies, investing in them has been a continuous thread. Although sometimes my day job has been different. So after I exited Snapfish, I also had the good fortune of exiting an investment in a Brazilian company, which became the largest mobile music company. It was run by a friend of mine from NYU, and so that exit was good as well. So all of these things actually helped me pay off my MBA loan and left me with a little bit of capital to figure out what I want to do next. And keep in mind, those days Silicon Valley was very, very quiet. Right? The aftermath of the dot-com bust was still resonating. This is '05. So I actually went back to my Wall Street roots, and along with my brother, I set up India's first distressed and turnaround fund called 8 Capital, which was seeded by JP Morgan. And so that was my day job. And so when you're doing distress investing, what you're thinking is what can go wrong. That's how you think all day. You try to protect your principal. The venture is the exact opposite. You think about what can go right. You don't worry so much about principal. So I was actually doing both. So more like a hobby, angel investing. See, it was very clear to me that the advent of the internet and mass adoption of that is inevitable even in India. Right? How it would happen, it was not clear. How these phones would get cheaper or how we're going to get broadband in the hands of everybody was not clear. But it was obvious it's going to happen, right? And so, actually, the first check I wrote into was Carwale.com at the seed stage. Okay. And that turned out to be a great investment. And I got some proceeds from that, and I recycled back into EzeTap, one non-tech company which actually went IPO. So, number of companies, I just kept recycling. So I never touched that capital for myself. Whatever came back, I rolled it back. So that's how the portfolio got built up.
Like a true trader, right? You predict your downside. You're like, okay, this is the money I made. Let's keep putting it back and see where it goes.
Actually, it's not so much of a trading mentality, Varun, because I'm not looking. I don't have a itchy trigger finger that I'm trying to exit a stock, right? And you can't do that. At the end of the day, you don't have that liquidity. But one thing I will tell you, what I learned from my trading days, I was very fortunate to have the first boss who was literally like one of the best traders in the world at that time. And he always told me, he said, Vikram, whenever you're investing, either be long or be short. Do not have a hold position. What does that mean? It means that you should just love something more and more and try and buy more and more of it as much as your ability allows you or your limits allow you, or get out. Do not be in this ambivalence, right? It means that you're hoping somehow something will happen, right? Or you don't know enough, neither of which is acceptable. So you should be for that, you have to be the most informed investor. So I think that has really worked out very well for me. To help me to become a high conviction investor, even in seed stage companies with very little information.
So talking about investing in seed stage companies, how has COVID been for your portfolio? How has this kind of like impacted? Has it actually resulted, were they COVID proof, right? That's a question that people are asking. Were your investments COVID proof?
So, in my angel portfolio, all the companies which were weak, interestingly, kind of shut down before COVID over the last 2 years. What remained were all companies which are, digitizing money or e-commerce or brands, digitally native brands. They've had an incredible run. In fact, I had 5 follow-on rounds in the last 4 months in my venture portfolio, and I'm not talking about just Series A, Series B. These are substantial rounds. Series C. I've never had a better quarter in my angel portfolio. It's phenomenal. So,
what has been your investment philosophy, though? Actually, can you tell a little bit about 8i? What you guys have been doing?
The role of the internet, even today, the primary role and contribution is really to remove friction from the analog world, so to speak. And so, what I have seen is the more you remove friction, the higher the adoption. Because the skeptical adopter can see the return on time, on savings or cost or effort or headache, right? So India is inherently a high inertia country, and so to the extent you can rewire digitally whatever customer journeys that you can, you will see quantum jumps in terms of improvement, right? So we've always, like, even Carwale was about reducing friction in buying cars. We did really well. EzeTap was removing friction in the last mile payment when you get delivery of your goods from Amazon or Flipkart. So on, so many companies that we back. So for me, we've taken always a friction first approach. Um, when we are investing, honestly, we're coming in so early. We've done a number of companies. All you have is literally the proverbial plan on a napkin. I've done that a few times, right?
Yeah.
Um, and what we really look for is the insight of the founder. Why is this person doing this? Why is this problem so important to this founder? We look for this authenticity between the connection, between the problem and the founder. And then, of course, you see, is this founder somebody who can actually execute? And what progress they have made recently in terms of moving in this direction. And that's about it. What you're going to do is going to keep iterating, every 3 months, 6 months. So, whatever you show me as a founder is just the first draft. By the time you hit product market fit, you could be on the fifth or the 50th draft. I do not know. So from our perspective, the problem is the North Star that will bring you back on track when something doesn't work. And that's what we care about.
When you have this thought process, does it ever strike you that the founder has to be pedigree founder? By pedigree, I think Indian investors have all these kind of benchmarks on what a pedigree founder looks like on paper. And you know what I'm talking about.
Look, I actually look at it slightly differently. For me, what I know that entrepreneurship is a very hard journey, right? You're going to get a bloody nose doing this thing. So anybody who is thinking this is going to be just fun and games, a lot of it is, but a lot of it is getting punched on the face every damn day and being told you're wrong and this is never going to work. So you need to be a stubborn kind of a person to actually do a good job here. Now, having said that, what I look for is some place where you've been competitive in your life and you've broken through, as opposed to uh, uh, you know somebody's had completely mediocre career in a sense. Because I'm having to make a decision on partnering with somebody for even a decade on very little information. So it's okay if you went to a great college which is very competitive. That's a great sign that you were able to put all the fun and games aside and put your head down and focus. You didn't go to a great college, no matter. Did you do that in your first job? If you didn't do it in your first job, show me some place where you exhibited competitive excellence, which allowed you to laser focus. That's all I care about. That means I know I have this person who has an ability to just go for it and build something. So you have to prove somewhere in the market. Right? That's how I see it. And it's fine. I mean, if you're a very young person, show me something. You know.
Speaking about that and having that mindset, one of the things that I've noticed in the US is that a lot of the new age investors, and famously the Founders Fund is a fund created by founders for founders. In the sense, they know what kind of support to give them, what kind of money they require, what kind of where they could actually step in and support, and which has resulted in a lot of massive mega hits for the fund, right? In India, though, a lot of investors are not founders. I mean, now maybe some newer investors, younger investors are founders. I think the funds have started to notice that. Are you seeing the same trend, like more founders becoming investors? I mean, yeah, and you probably were one of the earliest founders becoming an investor.
Not enough, but I think again this is another trend which is inevitable. I do remember, Varun, when I was raising capital for my startup back in '99, 2000, and I was pounding the pavement, so to speak, on Sand Hill Road, which is where all the VC firms are. Every
Yeah.
VC was a former investment banker. See, the internet was new, so I can't blame them, right? I mean, at that point of time, who had any experience building any internet company? The internet itself was launched 95, 96. It was more like an R&D project, right? So companies like Amazon actually popularized it. So, they had a very kind of like, the model was always living in Excel and do you adhere to an Excel model? And I think those were unrealistic assumptions. And I'm not surprised that we also had a 99% wipeout rate in the dot-com bust, very early adoption. Um, Today, if you see the best and the greatest VCs in Silicon Valley, they are all ex-founders, whether it's Mark Andreessen who created Netscape, right? Whether it's the Founders Fund folks, or it is Social Capital. All of these people have actually built phenomenal companies, exited them. They understand the journey. They have walked the steps of the founders they are about to back. So I think they are uniquely positioned as builders to support other builders. In fact, they want to take back control on every aspect of venture creation. That's why they want to do direct listing. They don't even want the Wall Street bankers to price their stuff, right? So it's really like occupy their world completely.
Yeah. Yeah.
When we look at India, I think again most of the VC folks have probably come in the early days from the PE world. Again, the PE world, a combination of people coming from banking and consulting. I think we will see the same trend here. We need our founders to get more exits. So as they get exits, they have some financial freedom. Then they start to build it out. What we want to do on our end actually is encourage founders to, at least those of us in our portfolio, to co-invest with us at the very early stages, right?
Mm.
We think actually seed investing is not hard. If
Mm.
you're a builder, I think it's much easier for you. That's my sense. I think we can be taught to be a phenomenal angel investor. That's my view.
That's an interesting perspective, right? Because I've always had this view that a lot of founders in India, given the number of startups that don't make it, uh, there's not a lot of cash left after you go through a startup, right? And that also means there are not enough exits happening, even for the top, quartile or whatever number of folks who make it. There may not be enough money left over to start investing. I mean, now you're probably seeing some popular investors, our mutual friend Jiten, who's made good money in his exit. I think Akrit, also Mumbai. I think they're all investors now. They've started to put a lot of their money out to go work for them, right? They've started to decide that. But I think a majority founders don't have that kind of fu money to go and do it, right? They don't have that kind of bank balance. Do you think M&A deals and exits will start also coming in to the Indian scenario? Is that also a trend that we are seeing?
I think that the next 2022 onwards, my sense is that you're finally going to see the venture asset class come on its own because you are going to have IPOs, right? If I look at e-commerce today, the scale at which e-commerce adoption is growing right now, look, I think just between the few large marketplaces, you might be hitting a $2 billion run rate a month at this point in time.
Right.
So I think by the time we end March 21, e-commerce will be 5% of Indian retail, believe it or not, or more than that. What that means is that it is now entirely possible to create a 1,000 crore FMCG brand purely online, which is born on Amazon and Flipkart and a big basket. And so if you have a 1,000 crore FMCG brand and you have 100 crore EBITDA, you can IPO and you're probably going to be worth close to $1 billion. You're going to have SaaS companies growing pretty fast coming out. You might have some payment infrastructure companies coming out, edtech companies, obviously. So I think we're going to have really exciting time where, today the BSE 500 has barely 3 listed internet companies. It's pretty amazing. So if you're invested in the Indian stock market, your life has gone digital. You're buying online, you're paying online, every transaction is happening online on your screen. But your portfolio is all offline. It does not participate Like you were saying, are you a COVID winner? Or are you COVID loser? Right? Your portfolio is in the loser segment. But and if you're in the US, you can buy FANG stocks, you can buy SaaS stocks, you can buy Uber, whatever you like. Right? You can express your understanding of what's happening in the digital realm and put it in your portfolio. So I think we are going to start to see that. Once that happens, Varun, you're going to see a lot more money coming in. Late stage, I believe the lines will start to blur between P and VC. Already, Everstone is putting money in Wow Shampoo. There is news of one MG raising $100 million from a couple of late stage PE guys. So there is that blurring happening because they can sense the IPO.
So you're saying that in those scenarios, private equity is saying even though they were typically investing in a 2 to 3x multiple, now they're kind of saying, we will take that bet even at this stage for a startup where the cash flow may not necessarily be there. And that's where the blurring is happening. Is that what you're saying?
No, typically PE comes in pre-IPO. When they have visibility, okay, like 2 to 4 years from now, the company will IPO. And they are figuring out that the new leaders are challenger brands or, infrastructure to power these brands. And if they don't, they miss out at the end of the day. So we are going to see a slew of IPOs. And I think some of those companies will become consolidators. And so you will start to see M&A happening, right? See, US always had Google, Facebook, before that Yahoo, AOL. These were all like giant vacuum machines just sucking up one company after the other. So you kept getting exits, whether it is 10 million, 50 million, 100 million, right? China had Alibaba, Tencent, and Baidu. So you got three of these guys competing to take you guys out, right? All these startups. Right. India doesn't have anything. Does PayTM go and make any acquisitions? Hardly, right? Did you see Flipkart make any big acquisitions? Hardly, other than Myntra, right? So I think we need more of those because you can't have every company IPOing. It won't happen.
You're investing early stage and seed stage. Now, in this time period, there's not much of data points like you mentioned, and you're investing in the founder. How do you source these deals? They also are not making waves that everybody gets to see them, right? Like a BlueTokai, you can actually visibly see that they have stores. You probably enjoy the product. I think both of us enjoy the product that they put out. So we're like, you know what? I want to be an investor. I see myself, growing this company. I can see this going places because there are thousands of people like me and do that. How do you then, kind of come across these companies? What's your process for deal flow?
Let me take a step back and explain to you why we set up this VC fund to begin with. Look, I was doing just fine as an angel investor. In fact, my angel portfolio is up about 54 times because I've been recycling, right? So I don't. I get the deal flow. It's not that issue, right? The idea of doing a VC fund was to really provide more capital to our founders and support them better. And the two areas that we wanted to focus on is fintech and e-commerce, right? And as we began to fund some of these companies, we realized that folks who wanted to build, exemplary experiences, the backend infrastructure wasn't there, right? So SlicePay wanted to launch a card. It was financing smartphones for students.
Yeah.
There was no infrastructure. Then we found M2P. So M2P powers the SlicePay card business, and so we ended up funding M2P as well, along with SlicePay, right?
Right.
So the point I'm saying is that look, as a former founder, I'll tell you one thing, and this is for all the founders who are listening to this or watching this podcast. You decide whether a VC is successful or not. The VC never decides. We are just money. Okay. If you tell me, Vikram, I do not want your money, I am helpless. I don't have anything else to offer you. I cannot be your co-founder, right? Once I'm invested, I can provide you some support, but honestly, I'm not sitting next to you in that bumpy ride all the time. I'm somewhere else at the end of the day, right? So I think the best VCs fundamentally understand that their success completely depends on founders picking them. And if you're choosing the right founders, they have choice in terms of who they pick. So the way we look at it, we say, okay, I'm a young founder. I'm just setting up whatever I want to do. Who do I choose? And the way we looked at it, I think that today there are a number of great VC funds in India. If you want to do consumer internet, you're going to make a beeline for somebody like Axel, right? If you want to do SaaS, you're most likely going to make a beeline for Nexus. But if you're going to do fintech, where are you going to go? There is no one single fund which has the infrastructure or I would say that depth which can actually really handhold you and build you up, right? So we think we have some fintech chops. You featured a few of our companies. On the other side, I would say again, if you want to build a consumer brand, there's a real dearth of choices. There's just Fireside. That's pretty much it, right? And we believe that fintech and consumer, these are two areas which are going to drive the growth of the Indian economy. With India is becoming a consumer economy, structurally it's moving in that direction. So we want to focus on these two areas and upgrade these two areas.
So you're focused on fintech and consumer, and I've picked a few of my startups, the guys who've come on this program as well, and this part of the show, I just want the investor, i.e., you, to just give some anecdote on how this investment happened. Something interesting about them. Could be anything that you want to share. So I'll just, we'll start with a company that I haven't mentioned much, but Signzy was one of those interesting investments in the regulatory tech space.
So, the way we identify opportunities, we do not use a market map at all. So it's not like I would look at fintech and say, okay, I need to do a KYC company, I need to do a consumer lender, I need to do a business lender. We don't think like that, right? We actually map customer journeys. So we say, okay, if I'm a consumer and I'm opening a personal account with a bank, what is that journey? Where is it broken? Can it be fixed? Right. So we break it down into first mile, middle mile, last mile. First mile is all about onboarding, KYC, what have you. The middle mile in banking is going to be about underwriting. The last mile will be about payments, collections, customer service, etc., etc. And we think that there are going to be billion-dollar companies around digitizing each of these touch points, each of these miles, the first mile, last mile. And the bank of the tomorrow is going to be very similar to like a Lego bank. As you migrate to the cloud, you kind of snap together these pieces through APIs because they're so complex. Each of these activities very hard to do. Signzy was interesting because Aadhaar was launched and it really created a mind-blowing experience that it was banned. You put your finger, open your bank account, it's blazing fast, it's fantastic, right? So it's just this like great experience till you go and open an account for your company. So Varun goes to a bank, puts his finger on this biometric device, opens the account in seconds. Now Varun wants to open an account for a startup. Oh hell, 3 weeks. You're still borrowing the rounds, right? Waiting when your account's going to open. So Signzy basically came along saying that, look, we are going to provide digital KYC in minutes for even small businesses, and nobody was solving that problem. So we knew that as we go ahead, we will digitize the kirana, we will digitize this entire market, and so it was a no-brainer for me. And I actually discovered them because somebody mentioned to me they won some RBI competition. I asked somebody casually. I reached out to them on LinkedIn, cold emailed them. So guys, VCs will write to you if they think you're doing something useful. It's not always one way. So some of my best companies, I reached out to them, I cold emailed them, and we sat down together, talked, and we closed a deal in 48 hours from the time I met them in terms of that. Yeah.
So that's kick-ass. Next is, of course, BlueTokai.
So BlueTokai was a little bit different in the sense that was more my own experience as a customer. So interesting, I'll tell you, they're really, when you compare the consumer founder and the enterprise founder, is very interesting. The consumer founder typically comes from the community of customers, right? That they are catering to in the end. So if you look at Matt, he was a coffee nut for years. Like he's crazy about coffee, right? He will go to the end of the earth to source the best beans, roasted in his kitchen stove, and make sure it's perfect. He's fanatical about his best coffee experience. So he made coffee for himself. Enterprise guys are a little bit different. They will keep iterating, keep asking the customer. They will have an insight and build it according to customer needs. Consumer guys don't always do that. BlueTokai came about because I was actually a tea drinker for a long time. I happened to be in Colombia on a short vacation. I was in the US. I had a long weekend free, and that's one of the few countries you can go without a visa. You can go with your US visa. So I popped into Colombia with my wife, and we went to a lot of great coffee roasters, and I came back a coffee convert. I came back to India after my vacation, and I was now craving this pure coffee, and I guess the only option was BlueTokai. There I happened to meet Matt, and we started talking. He turned out to be a junior from NYU. We connected, and we decided on the spot pretty much. I met him for half an hour. At the end of the conversation, he had something left from his round. I committed right there, and that's it. That's how we started. So it's always been, yeah. So I think when you see something special, you don't take too much time to figure it out at the end of it. I mean, you can do your DD to make sure that all your assumptions are correct, but you pretty much know within the first half an hour if you're going to invest. At least that's how it's been for me.
I want to ask you about your investment in Carwale, right, which got acquired. How did that happen? And if it is one of your first checks, what basically made you write that check?
So it's interesting. When I was doing my first startup, the founder of Carwale, Mohit, was working with a friend of mine. And my friend was actually helping us get up some licenses for a software technology park in India. And Mohit, for some reason, was involved in helping us do that. So while I was in the US, and it so happened that there was a certain week when I was looking to buy a car, and I was going up and down the street here in Prabhadevi, Worli, visiting all the dealers. And the same friend of mine invited me for lunch, and Mohit was sitting there, and we started talking. And then at the end of the dinner lunch, I think I asked him, "What do you do?" He said, "Oh, I run this online site for car comparison." I'm like, "Damn, I wish I knew there was something like this. I would have saved myself a week." So we quickly jumped on a desktop, and he showed me how it works. It was live. It was working very well. He had good unit economics, and so we committed right there. Literally, it took us 15 minutes. I said, "Okay, man, I'm in." Um,
so the thing is, you were close to the pain point, and you found that this is an interesting way to solve it, and somebody's actually doing it, and you are at arm's length with this person, and you're like, this is what it is, and you just committed.
Once you experience the friction, you can try to fund it away, right?
You like hot sauce, and you've been talking a little bit about it. So I'd love your thoughts on why hot sauce, why India, and what is this company?
Oh, this is Naagin. Yes. So Naagin is another company which is a very interesting company. It is trying to create India's authentic hot sauce. And we seeded them again very, very early. I think they just had some early product. It didn't even have a label on it. So, again, here what happened was I'm a foodie. And after much searching, I thought I had found the best cloud kitchen for pizza, which is Francesco Pizzeria here in Mumbai. And I became a regular. And I'd order food from his pizzeria as well as pastas all the time. And one day, a friend of mine, Vikram, who's also active angel investor, called me and said, "Hey, listen, do you want to check out a hot sauce company?" And I said, "Oh, I don't know, maybe." So I said, "Who's the founder?" He said, "Oh, he runs this cloud kitchen called Francesco Pizzeria." I said, "Listen, I'll meet him because I love his product." So Mikhail came, and we were talking, and he was obviously delighted to meet somebody who loves his food so much. So I knew that this founder would actually understand and had an idea. It's not like, somebody who's been an investment banker, never went to the kitchen, one now wants to build, a hot sauce brand, right? So he brought a sample with him, and I tried it. I'm like, this is brilliant. Let's do it. Look, I'll explain to you where it's coming from. At seed stage, there's very little information. What you have is who is sitting in front of you, right? And you have to take a call whether if this thing works out, where it's going to go, right? Now, I can tell you, I was very fortunate. I was a young kid. I was in New York, and people gave us millions of dollars. They did not know me. They didn't know my family. We didn't even have a warm connect. I was just 2 years in America, and they gave me, all this huge check. So if they can trust me, I can trust other people. I have a blank check relationship with anybody I meet for the first time, right? It's for you to write the amount, as far as I'm concerned. That's it. What's the worst that happens? My investment goes to zero, right? If it works, hey, we all do really well. So the optionality is so beautiful that you got to keep doing it all over again, and that's how I see it.
No, that's interesting. Where you're basically saying that in early and seed stage, you're basically meeting the founder with an open mind, and you're saying, okay, let them wow you, and if it's a product that you resonate with in a way, and that's just gut, right? You're not actually checking anything else. It's just gut. You feel like this is something that's going to work because of all these data points that you're observing and interacting with, and you make the decision. It's not, a mathematical decision. It's more a gut decision.
Well, I would add, all investment decisions at seed stage will be gut to some extent, right? But I think, like I mentioned, we map the journey, right? We're very, very clear why I would buy this product at the end of the day, right? So when you're looking at consumer products like BlueTokai, or you're looking at a Naagin, and we've got another company called Monks's, which is making nutraceuticals using Indian superfoods. I'll tell you what is really common between all of these three companies is we figured out that the young Indian consumer who's aspirational, who's upgrading, they when they are upgrading for something, they are actually looking for the packaging to be very modern, very intense, right? Very contemporary. They want the whole Brooklyn vibe and all of that. But the soul of the product, they want quintessentially Indian values, good, wholesome Indian values, right? So if you see what is in the Naagin hot sauce, it's your regional chili that your grandma would have made a pickle with, achar, right? They are giving it to you in a hot sauce form. So they're going to go region by region, pick the chili. So they're actually doing one Andhra chili, right? They take the Guntur chili, which Guntur pickles are great, but they're going to put it in a sauce form that maybe you will enjoy more, right? If you look at BlueTokai, what does it do? It goes and picks the best plantations, promotes them, but the whole packaging, the experience is very Brooklyn or Berlin, whatever you want to call that, right? Nutraceutical, the same thing. They're going to take your Ayurvedic stuff, put it into some effervescent stuff like a tablet, and you drink it like something nice and fizzy. So the vehicle that you're consuming is always going to be something very, very Western in a sense. But the soul of it is what your grandmother would approve. So we see that trend playing out over and over again.
Not all seed investments go as per plan, and I know that you've had a little bit of a challenge with one of your investments. Do you want to talk about that one? How things kind of fall apart, and some of the reasons why something could fall off the rails.
So I wouldn't name the company, but I think it's important to talk about what goes wrong in a startup. I see the greatest value destroyer in all my portfolio companies has been co-founder conflict, honestly. And that co-founder chemistry is very hard to judge. Like the worst disaster we had, honestly, the co-founders are all together in IIT. They knew each other from college. There were three co-founders. Two of them knew each other from IIT. Then they also overlap with each other at IIM Ahmedabad, right? So with that long a history, at the end of the day, of course they had not worked together throughout, right? But how else are you going to find your co-founder at the end of the day? So I think it is hard. So one of the things you want to do is observe these co-founders very, very carefully when you're in a meeting. If it's very obvious, one guy's cutting off the other or whatever it is, I think then there is not going to be much harmony. But this is very unpredictable. I think if you cannot predict how long marriages last, how will you predict these stuff? But in general, I think it's been a good experience. But my message to founders listening to this is, a lot of times you have a great idea, you want to launch quickly, and you feel you must bolt on a co-founder who's a CTO or the business guy, depending on your situation, because that's the only way to build and grow. I would say take your time. Choose somebody that you can be with for about 7 to 8 years. And you're going to spend more time with this person than you spend with your spouse. So try and imagine and visualize that situation. It's going to be better for you. That's how I see it. See, because for a founder, it's like 110% of their life, right? For us, you're part of my portfolio.
Right. It's an important part because, you also have limited time and limited investments. So, you're also making those kind of calls saying, do I want to spend my time with this portfolio and this founder? And for what, right? Of course, there's a financial outcome, but you're also going to have that emotional and mental kind of investment into that business.
You can't help that. I don't think that I've abandoned any company, honestly, which was not working out. I've done my best. I've tried to intervene if I could, try to resolve things between the founders. Look, it's very hard to build a company. And I think once you have your initial team, that itself is a great achievement, right? To get people to believe in your vision, to get people to take lower salaries very often and take your ESOP, right? So I think it's very important to respect that. And sometimes companies go through some periods, I think I'll tell you one thing, Varun. We are not in the investing business. We are in the believing business, right? Once I've made up my mind to believe in you, it's very unlikely my belief will get shaken, right? If things fall apart, it's fine. We actually tell our founders, if you've done your best, you've acted with integrity, all of that stuff, come back to us. I paid your tuition fees once, right? I might as well participate in your journey when you're going to do it right. So we feel every founder has 3-4 ventures inside there, and we are happy to go along each of these journeys with you. It just depends, right?
How do you deal with cold emails? If somebody wrote to Vikram at 8i.vc, what would happen?
If you write to me directly, I'll respond to you. If you send me an email through a banker, I will not respond to you. I'm very clear. You're at seed stage or Series A, you're using a banker, you're not going to be able to raise capital. You're not going to, in fact, even convince people to come. You write to me directly, I will definitely respond. Very clear.
Awesome. All right. Those listening to this podcast, do reach out to Vikram. He's a great guy. Even if he doesn't write you a check, he'll definitely help you out. Vikram, this has been awesome. Thanks so much for taking the time.